Hey, welcome to my YouTube channel. Make sure to subscribe if you haven't already. So I'm just going to do a quick update on Upwork and some stocks that I would recommend it as far as stocks to watch for 2020 and the next week with upcoming catalysts. So Upwork is up around 40%. I looked at this and I put it the first video I made. That was one of the first videos on my channel. It was around $15 because it would be $28.24, mainly because of its run up today of 40%. Yeah, the earnings call was amazing. Everything was up. The CEO is amazing. Now, on the other hand, Elf I thought would do better than Upwork than all of these companies. Yet it didn't perform nearly as well as I thought it would. And it will continue to perform well. It's just that it didn't perform nearly as well as people thought for this particular quarter. So now we're going to go into Revolve. Revolve is a company that I have price targets of doubling our money, and I really do think it will happen. And I feel like I need to give you some more of the financial standpoints and value standpoints of the company, even though I do it a lot because I tell you how undervalued it is. Um, I just want to give you some more numbers that you can actually go off of. So Revolve went public in 2019. In the middle of 2019, the ticker symbol was RVLV. It's trading on the New York Stock Exchange (NYSE) market, and it was founded in 2003. It's located in the United States, so it's a really good company as far as location and how long it's been here. It's been here a good bit of time. So we're going to be comparing Revolve to the S&P 500, and we're also just going to be looking at it in general. And this really will explain why I'm so very bullish on this company. So the PE ratio for this company is 37.9, which by a glance looks really high, but compared to the S&P 500, and yes, it is trading at a PE ratio of 42 today, it doesn't look that high. The PS ratio for this company is 2.32, which is really well, because if you look, so you may not know what PS ratio is, but a PS ratio of 1 essentially means that you're paying $1 per $1 of the company's sales. So for every $1 sales and every $1 invested, that's basically what you have. And so this is a P ratio that's really close to 1 at 2.32. And by the way, a lot of these ratios are for the trailing 12 months. And the reason why I did that is because it really doesn't really matter, because the fact that the company's end of the fiscal year is December 31st. So that is okay. And by the way, they'll be releasing earnings on the 11th of this month. So I'll talk about that a little bit more later. But remember, I'm trying to really get into financials a lot in this video. So the PS ratio is really lower compared to the S&P 500. The PB ratio is a little bit higher than the S&P 500, but I still consider this company severely undervalued. Way, just really undervalued. The price to free cash flow, which I know a lot of people don't look at or care about, but it's also really good to look at. So it's 15.35, which is also below the S&P 500. And so if we looked at just those four ratios, which are very important ratios, well, then it's a 3 out of 4, and that is really amazing. But that's not the only thing. That just gives you a little glance. So we see the market cap is at $1.34 billion. And in 2019, the earnings alone was around $35 million. And so that means for the market cap today to be justified, 2020 earnings are going to need to be $35 million. And so how did I get that? Well, I divided the market cap by the current PE ratio to get that. And so you get that the earnings we needed are going to be a little bit less than 2019 earnings, which is an extremely bullish thing. So the last quarter earnings alone were $14.2 million, which is almost half of what they need for 2020. And so if we multiply that times 4, because there's 4 quarters, if we multiply that times 4, then we get 56.96. That is what we can expect from this company in 1 year from now, just based upon the last quarter earnings. But the percentage of 2019 earnings needed, if you want to look at it that way, maybe you don't really like to look at numbers. Well, the percentage needed is only 99%, around 99% of the 2019 earnings, meaning that you don't even need as much earnings as you did in 2019. It can actually be a little bit less than that. Therefore, anytime the market cap is around 1.4 billion, I consider this company is at really good value. And so the current price of this company is $19.31. And I said in my previous video I would like to see a drop, but I do think it can reach $50 to $60. And so now it's around there. I think that is a really good opportunity to invest this company at this price point. But that's not the thing you should look at. Really, the market cap, 1.3, 1.4 billion, anywhere between there is a really good buying opportunity, because if 1 year from now, if they continue what they're doing, we should really gain all that back as far as value go, and actually how much sales and earnings they're producing. Well, then we should get it all back in a year. And that's not even including the market sentiment, which I expect to go up as Nordstrom, a short squeeze is coming, and people will be more bullish on the sector once that happens. But if you're not even looking at all the growth in market sentiment and things like that, that you can't really control, but I do expect to happen, well, this company will double, in my opinion, just based upon all of these numbers. That's not even including everything else I'm looking at. So the 52-week high is $24.41. The 52-week low at $7.17. You can compare that to the S&P 500. And so this is in thousands. All this is in thousands from here to here. So remember that. Anyway, so the revenue for the trailing 12 months is, I'm just going to refer to it as 590,000, but that is not accurate. Remember, this is in thousands. So 590,000. The cost of revenue was around half of that at 286,000. The gross profit at 303,000, which I got by subtracting the revenue for the trailing 12 months from the cost of revenue. And so we get gross margins of 51.44%. Compared to the S&P 500, well, then we have a pretty good gross margin, and that is a really good gross margin on average. Even if you're a little bit below the S&P 500, that means you're one of the highest companies out there as far as that goes. And so the operating expenses for this company, you can see what it looks like, 257,000, or you can round it up, 258,000. The operating income at 46,000. The operating margin, which is the only thing the S&P 500 is doing better than them at, is the operating margin. But remember, the management is great, and this company is really well-rounded. So if you just look at that, you'll be really deceived. So don't click off the video now. As well as like the video if you got any value out of it so far, as well as subscribe if you're new. So the revenue growth year over year, I'm looking literally last year, not on average, because I want to see how it got affected from COVID-19, and it's negative 12%, negative 11.8%. So yes, it's down in the revenue growth quarter over quarter. Literally last quarter is what I'm looking at, the last 2 quarters. So I'm not looking exactly on average, but it's negative. The reason I did that is because, of course, it would be positive if I looked at all the quarters. I want to see how it's affected from COVID-19 and how everything's been affecting this company. But with that being said, like I said, the earnings and the quarter results, things like that, will be coming out very soon, like in a week from now. So it will be November 11th. Mark that on your calendar. And then you probably want to update this. Yeah, I would probably do an update. I don't know if I will or not. So the total cash, remember, this is not exactly accurate either. It's not $151 in cash. But you can see I'm going to refer to it that way though. 151 cash. Total current assets 240, total current liabilities 102. The current ratio is above 1, meaning they have more current assets than current liabilities at 2.36. Companies in this sector almost all of them have more liabilities than assets. So this is a very good thing, because it's not like it's 1.1 or just barely at 1. This is at 2.36. So currently right now, their debts and their assets look really good, and they're in a really good place financially, especially for the current financials, not long term. Long term, they're good too. The total assets at 272, the total liabilities at 121, and if we subtract that, we get stockholder equity of 151. And then if we divide that from the shares outstanding, well, we get a BVPS, or book value per share, at 2.18. And so now I want to look at the management effectiveness. Now, I kind of probably throw you off about the management, probably are concerned and want to do some research on the management right away because of the operating margins. But this is the true test of the matter. When we look at the current ratio, the quick ratio, and all the R's, the return on assets, return on equity, the returns on investment capital, well, we can really see how this company has really been doing. And so we see that their assets are more than their liabilities, long-term and short-term. The return on investment capital was pretty high. I couldn't compare to the COVID-19, to the S&P 500, because I couldn't find it. But the quick ratio is higher than the S&P 500, meaning this company is really good financially compared to a lot of other companies out there, not even just the ones in this industry, which by its industry, it's way better. So the return on equity is almost double that, more than double that of the S&P 500 at 27.68%, and the returns on asset Assets are 12.08%, which is almost six times that of the S&P 500. So this company financially is really well, really sound, and I think now you can see why I expected to double my money just financially, not even considering the fact that the market sentiment will be up from this extremely bearish sector that has been bearish for a good bit of time. So, that's just one thing that proves this matter of that. Proves it. So we also want to look at the catalyst, which is the earnings. I've talked about that. November 11th, mark that on your calendar, because for the past 4 quarters, this company has beat outright what all expectations was for this company. And I expect it to either miss by a lot or beat by a little. I don't really expect it to do the best or the worst. It just will be okay or to be kind of bad. And that's what I see for it as far as earnings. So we can look at the financials. Annually, this company looks really good financially. I showed you literally 1 quarter over quarter and literally 1 year over year. But I want to show you for all 3 years, or now almost 4 years, this company has been public. And so you can see everything looks really good, earnings-wise and revenue-wise. So if we look at the recommendation ratings for this company, well, the company has a pretty good recommendation rating at 2.1, which is between a buy and a hold. So people are a little bit more bullish than you can say bearish. That's pretty good. But I believe the last time I reviewed this company, it was around a two buy. So that's it shows that people are a little bit more bearish since the making of that video, which you can check. Anyways, the average analyst price target is way higher, about $6 higher than the current price at $18.52. But remember, this company is trading now at $19.31, because when I make this video, that's where it's trading at. But now it's up around 6% or 5% today. Anyways, the point of the matter is that people are more bullish on this company. It's an average of $25, a high of $32. Yet my price target is around $50 to $60, and now you can see why. So these are the 4 M's for successful investing. I know I don't mention these a lot in my videos, but every time I'm researching a company, I look at it, which is meeting, moat, management, margin of safety. That is the 4 M's for successful investing, or for a successful business. They need to have all 4 of these things. I consider a moat a margin of safety, in my opinion, because I mean, if you literally search a moat, it's a wide ditch that surrounds a palace, castle, something like that. Well, I consider that a margin of safety because it really is safety. So it's a really good margin of safety. And if you don't consider that, well, remember the fact that this company is undervalued right now, currently. So that is something else you can look at. And the meaning for this company is amazing. The management is amazing. So make sure to like, comment, subscribe. That's all I have for you today. Yeah, make sure to subscribe, like, and comment, all those good things. As well as you can check out the stock reviews that I've done, full stock reviews I've done on Revolve in the past. But today we were just looking at more financial things, maybe more of what a value investor would do if they were doing a stock review on this company. Also, definitely check out this company named Upwork. You would have doubled your money if you were subscribed earlier. Anyways, this company is a pretty good company, and I think that this was well deserved. This has been deserved for this type of company. And honestly, at current valuations, it's still pretty good long term, but definitely I would invest in it today, as it is up 40%. I mean, that is a really good valuation that now I do expect it to drop a little bit more after it has dropped this much, maybe around 3 or 2% more tomorrow. But after that, I think it would be a great valuation, because you don't need to be the technical analysis expert to see that every time it hit under $20, in a matter of time, it went back up. And if you don't consider $20 the point that it did that, $17. Right now, it's right there under $20, and I expect anywhere between $17 to $20 is a really good price point to enter into a company like this with so many growth aspects like this. Anyways, that is Revolve. Hopefully you found this review on this company very helpful. If you did, consider liking, subscribing, and commenting down below when you do those things. Thank you for watching, and goodbye.